Hello everyone. I hope everything is good with you guys. Yet another free webinar with the same rock star. This is your friend Vivek Bajaj, co-founder, Stockage and Indian Markets. And you know, I'm always excited when there is something really nice coming up as a series of knowledge imparting to all of you. And we have the same star who provided free knowledge to all of you. Yeah, literally it was free because the money went for charity, but the star has again come back, and now this time he is decoding the science behind options trading. This time, this exercise has been supported by one of the largest exchanges in India, Bombay Stock Exchange, through their initiative BSC Investor Protection Fund. I have a representative, Mr. TG, here with me, and he is going to host this show. He's going to be your man, and he's going to invite Mr. P.R. Sundar later. Mr. TG, how are you doing today?
Doing great. Thanks, Vivek. Thanks a lot.
Thank you so much for becoming part of this initiative. BSC has always been in a front runner in educating investors, in creativity, in creating new products for the right traders and investors. So I'm glad that we are associated with you as a platform provider for this fantastic 1 hour and more session of Mr. P.R. Sundar. Mr. TG, a bit about you, and let's take it over.
Thanks, Vivek. Thanks for your introduction. A warm welcome to all the participants over here. I'm very happy to participate being with Mr. P.R. Sundar and with Elan. This is the first time we are doing it. I'm so thankful to Vivek and thankful to Sundar sir for giving us the opportunity to join you guys. Basically, now you must be hearing more about COVID and Sensex going from 30,000 to 20,000 again coming up, Nifty going around and again coming up. Full volatility and research and returns are not that great. Everyone is worried about volatility. This is what you are hearing and must be having a lot of webinars. Not only this webinar, you must have heard and attended a lot many webinars, and you are flooded with webinars. You must have felt like boring now. But this is going to be very interesting because of two reasons. One is like the BSE, the stock exchange, oldest stock exchange in India, had come out with some new option contract called options on the goods. This is new of its kind. Nowhere it is available in other than Indian markets now. Currently, SEBI admitted this. So we learned something about options on good. It is not options on commodities. Rather, it is not options on futures. It is something called options on goods. Now, I would call upon Mr. Sundar to give the broader discussion about the commodity options, basics, history, how it is developed, how a learner, a new trader, or a jeweler, or a exporter, importer can use the option to hedge their price risk. With this, I would now over to you, Mr. Sundar sir. You can take it. The participants are waiting for your speech, sir. Thank you, sir.
Thank you. Hi, this is P.R. Sundar. Welcome to the webinar, Options Unlocked. Recently, I've been very active in YouTube, and I'm trying to educate the people. And what many people told me, sir, you are catering to already skilled people in stock market, but you are not doing anything for the people who do not know even the basics. Then I thought I must be doing something from the beginning for the basic people. And that time, fortunately, Bombay Stock Exchange of India Vice President called me and he said, sir, can you do a webinar? BSC will be sponsoring it out of the Investor Protection Fund. Then I thought this is the good time to start. There is a proverb in Tamil, Karumbu Tinna Kuliya, means they are asking me to eat the sugar cane and they are paying for it also. So I immediately agreed, and the topic chosen by them is Options Unlocked. So what is it we are going to discuss? We are not going to discuss any strategies, any advanced things. So it is a basic understanding of what is option. Options unlocked. Is the stock market gambling? History of options. Forwards, futures, options, call options, put options, covered call, cash secured put, and hedging advantages and disadvantages, and trading through options. So these are the topics we are going to cover, and we will be talking about few minutes only based on every topic. The first question is stock market gambling. There is a general perception. The people who are outside the stock market, they think that stock market is gambling. Surely stock market is not a gambling. You want to do a business, you need 50 lakh capital. You have the capital, you start the business. You want to start a business, you want a capital of 5 crore, you don't have 5 crore, you look for 9 other people who can contribute 50 lakh each. The 10 of you put 50 lakh each and put together, you start a business. That is a partnership business. And you want to set up a business where you need 100 crore, even 10 of your friends cannot afford to pay 100 crore. Then you give their shares to the public, and the public come and subscribe to your IPO. Then you get and you do the business. So without the share market, no economy can survive. And if it is a gambling, I'm sure even the most conservative countries like Muslim countries, Gulf countries, so they are also allowing stock market to function. So therefore, definitely this is not gambling. But however, some people have made it as a gambling. People can make gambling out of anything. If you have a matchbox, you can light up a candle or you can torch a house. It is not the mistake of the matchbox. It is your mentality, the person who is handling. Knife can be used to cut the vegetables also or to cut the people also. So it is not the mistake of knife. So stock market has been brought for the purpose of developing the business, supporting the economy, and rewarding the investors. But generally, people who are outside the stock market, they think that stock market is a gambling. And sometimes people who are in the stock market, they're dealing only with the cash market. They think that the futures and options is a gambling. And sometimes the people who are playing in futures, they think that options market is gambling. And sometimes in the options market, option sellers think option buyers are gamblers, and option buyers think option sellers are gamblers. So this is the myth. So what is the thing? So why all these things have been brought? So what is the purpose of futures and options? I'm going to explain that. Now, first let me tell you the history of options. Sometimes in the 4th century, a mathematician, Thales of Miletus, and he was the first call option buyer in the history of mankind. And what did he do actually? He is very good at mathematics, and he is also an astronomer, and he can look at the stars, and he can predict the weather, and he can predict many other things. So those days, the people used to grow olive And once, by having his astronomical knowledge, he predicted that this time there is going to be a huge harvest of olive seeds. And whenever more oil seeds are produced, it has to be converted into olive oil and using a machinery called press. So people used to hire the press to convert the olive seeds into olive oil. There are people who lend these machineries. And what Thales did, after knowing that there is going to be a huge harvest, he thought there is going to be huge demand for these presses, and he approached all the press owners and gave them a small token, and he booked all the presses. And after a few months, when the real harvest came, nobody expected such a big harvest, and there was so much of olive seeds, and everybody want to convert that into oil. So the demand for presses shot up, and then he rented those presses at a higher price, and thereby he made a sizable profit. So those who know about options, you should know this is what the call options people do. If you expect the market to go up, you buy the call option, pay some premium only, 10 rupees, 20 rupees, and if the market shoots up, your 10 rupees, 20 rupees option premium goes to 80 rupees, 100 rupees, you make 4 to 5 times your return. Although the word options was not derived those days, and in the 4th century, Thales of Miletus was the first guy who captured this opportunity. It is a leverage play. Then what happened? Sometimes in the 17th century, there was a flower called tulip flower. And this tulip flower was a very popular one in the European region. And those days, usually it used to be in white color. Now, the talk of the world is coronavirus. Coronavirus is affecting everyone. And viruses do not only affect the man, it also affects the animals, it also affects the plants. So these tulip plants were also affected by some virus. What happened? Because of this virus, the color of the tulip flower changed. There was some mix of other colors in the white. And for looking, it looked very nice and everybody liked it. And the people have gone crazy about it. And the prices of tulip bulbs started shooting up. It started selling for $1, then it came to $2, then $5, then $10, then $100, then $1,000, and it came to $10,000. And then you dispose all your properties, you go and buy $10,000. Then I look at you, I say, are you so stupid? For one tulip flower, you are paying $10,000. The next day, I become stupid because the price shot up to $15,000. So this is the kind of craziness has happened. And here you can see one tulip flower. It's called Semper Augustus. Semper in Latin language means always, and Augustus is the name of the king, Augustus Caesar. So this flower is always the king. So that's why this name has come, Semper Augustus. And look, for you and me, it looks a normal flower. And believe me, this flower, one flower was traded for 12 acres of land. 12 acres of land was the price of this one flower. At the peak of the craziness, the tulip flower, one flower, shot up to 35,000 US dollars. Or to give you another analogy, a skilled workman's 10-year salary was the price of one flower. And then what happened? The market crashed. So during that time, people used to hedge their positions using call option and put option. Though they were not aware what is call and what is put, but in practically, so they have done everything. Of course, the market was not regulated market, and this is the second best known put options and call options in the history. And after this, they've given a name for this called tulipomania. So people buy without looking at the intrinsic value. One tulip flower cannot be $20,000. In its intrinsic value, its real value is not that. People still buy because they think that it can be sold for $25,000 or $30,000 later. So for this kind of mentality, they've given a name called tulipomania. You just go to Google, type tulipomania, you will get all the details. And in fact, nowadays in stock market, they use another name instead of tulipomania. They call it as a greater fool theory. A fool is buying a share at a very high price, much higher than the intrinsic value. That is because he's expecting another greater fool to come and buy at a higher price so that he can exit. So these were the two historical incidences where put options and call options were used. And so far, these stories, interesting stories, but people who know what is put option, call option only, they can understand these stories. For others, I will come little later. So usually the agriculture commodities, the prices fluctuated so much. I personally had a small farmland. I had some mango trees. When my mango is being harvested, and believe me, 1 kg of mango used to sell for 5 rupees. When there is no harvest in my trees, and mango used to sell for 40 rupees, 50 rupees. So people thought how they can do the hedging for this agriculture commodities. So that is the first line of thinking while people brought the futures and options market. So in 1973, the Chicago Board of Options Exchange introduced the options contract. And in 2001, India introduced options contracts. And now India is the largest options market in the world. Even in Indian stock markets, more than 80% of the volumes are traded in options. Why options? I always tell people used to play in futures where the risk is very high. I tell you a typical journey of people in the stock market. The first thing is that people from outside, when they've never ventured into stock market looks very, very glamorous. There are two fields. I tell them that this is a dream factory. One is the movie field, Bollywood. Another one is the stock market. So everybody want to come, everybody want to achieve something. But remember, everyone going to Bollywood cannot become Shah Rukh Khan or Salman Khan. So just for joke, I used to tell, stock market is like a marriage. All the people who are not married, they want to get married, and all the people who are married, they think why we got married. Okay, this is just for fun. So people who are outside the stock market, so they want to come to the stock market, and they come and they invest. And people generally, they don't have patience. Sometimes you buy a stock, for 10 years, the price will not go up. The best example I can give you, Reliance Industries. Reliance Industries is the most valued stock in Indian stock market. From 2008 to almost 2017, for nearly 10 years, the price was the same price. It was going up a little bit and coming down a little bit, and it did not rise meaningfully the 10 years. But what happened in the next 3 years, it has shot up 3 times. So if you keep the money in bank FD, you get regular interest. You put 1 lakh rupees. After 1 year, it become 1,10,000, then 1,20,000, 1,30,000, 1,40,000, like that. So that is called linear payoff. But whereas stock market, for 10 years, you will get 0 return. In the next 2-3 years, you can get 300% return. But usually, I tell people, generally people buy. So they ask me, sir, when my shares will rise? I used to tell them, the share will rise only when you sell the shares. So somebody who bought in 2008 Reliance Industries, holding for 10 years, got fed up. The price never gone up. He disposes. Then after that, it shoots up. So generally, the perception is that the cash market reward is less. And the moment they come, they talk to a few people in the stock market, they talk to the dealers, brokers, and then they learn something about futures. And they see future is very exciting. They enter into futures market. But futures market is a very, very high risk market. You pay only 10% of the margin money. So if the price goes up by 1%, you make 10% profit. But if price goes down by 1%, you lose 10%. Right? So by the time they realize that what they are doing wrong, it's a high risk, and they would have lost the money. So cash market, reward is less. Future market, risk is high. Right? And then with the little money left, they explore other options. Some people who are lucky, they will still have large capital. They look for other avenue. And that is where the options come into the picture, and which is a fantastic field. So just for fun, I used to tell, futures have no futures and options have plenty of options. There are 3 types of participants in the markets, called speculators, arbitrages, and hedgers. Speculators, no need to say. People who think market will go up, they buy. Think the market will come down, they sell. So that's called speculators. Second type of people are arbitrages. And once upon a time, arbitraging was a very good business, but nowadays, because computers take over the market most of the time, algos keep looking for the small arbitrage opportunity also they capture. So generally, individual people, they don't do arbitraging, but some institutions do. And we come to the third one, hedgers. So Whether futures or options or many other things have been brought for the purpose of hedging, but many people have made it as a speculation. So here we are going to focus on the options as a hedging tool. There are three things. One is called forwards, futures, and options. So let me explain one by one. So forwards, what is forward? And I'll tell you a small example. Let us say I'm manufacturing pen and I'm exporting to US. So all the pen reaches the stores in US, and US people, they will not be paying more than $1 per pen. That's the standard price because of competition is there. My cost of production, including of everything, it works out to be 70 rupees. $1 is 75 rupees. So when I sell for $1, I get 75 rupees. My cost of production, the total cost is 70 rupees. So I'm making 5 rupees profit per pen. I'm very happy. But there is one risk for me. Today, $1 is 75 rupees. And tomorrow, Indian currency may appreciate. In case Indian currency appreciates, if $1 becomes 65 rupees, then what will happen to my business? Because when I sell pen for $1, I'm going to receive only 65 rupees, but my cost is 70 rupees. I'll be losing 5 rupees. So this is a risk I am carrying. Okay, now come to you. You want to send your son to United States of America for higher studies. There, he needs $1,000 every month for his expenses. And he is asking you. You calculate. Now, $1 is 75 rupees. So your son asking $1,000, that means 75,000. So you can afford to pay 75,000 rupees, but you cannot afford to pay more than 75,000 rupees. Now you want to send your son to US. Now the question is, in case if the rupee depreciates, if $1 becomes 85 rupees, then when you give 75,000 rupees to your son, he will not be able to get $1,000. He will get less than that. So this is the risk that you are carrying. If the currency appreciates, I have a risk. If currency depreciates, you have a risk. Then what we do, we both come together and make an agreement. Your son is going to study for 1 year in US. For the next 1 year, I give every month $1,000. You give me every month 75,000 rupees, irrespective of the price of the US dollar. US dollar may go up or may come down. So you are also happy because in case currency depreciates, you don't have to worry. You don't have to pay extra money. You pay only 75,000. And I'm also happy in case if currency appreciates, I don't get less money. I still get 75 rupees per pen. So this kind of contract is called forwards contract. So these forwards brought in for the purpose of hedging. Then what is futures? Futures and forwards, there is a small difference only. Let us say money is not a problem for you and you want to send your son to US. You are worried whether he will be able to get dollar or not, no matter how much money you are giving him. The same way, I'm an exporter of pen. I'm also not worried about the price of US dollar. Okay, I'm just worried that will I get Indian rupees or not. So in that case, we both come to an agreement. Then I tell you, I supply $1,000 to your son every month in US, and the equivalent money you pay me here. It is only an agreement to pay the dollar and the rupees. The price is not decided. The previous example I gave you, the price is decided at 75 rupees, but now price we are not deciding. If tomorrow $1 is 65 rupees, I give $1,000, you pay me only 65,000. If tomorrow dollar is 85 rupees, still I pay $1,000, you pay me 85,000. So this kind of contract is called futures contract. So this is what you see in stock market, futures trading. And then I've explained forwards, explained futures. Now coming to options, the most important thing. I'll give you one real life example. Let us say today India is playing a cricket match. In cricket match, Virat Kohli is coming for batting. And we all know that he's a good batsman and is likely to hit many, many runs. And there you have a strong feeling that Virat Kohli will surely hit more than 100 runs in this match. You think he will hit 150, 200 runs, but definitely more than 100 runs. And somehow I think that he's not going to hit 100 runs. He will be out before reaching 100 runs. And then what you do, you're coming to me and telling me, sir, Virat Kohli will surely hit more than 100 runs. Then I tell you, no, it's not. He's not going to hit more than 100 runs. Okay, then you say, sir, what is the bet? And I pay you 20 rupees. I pay you 20 rupees. If Virat Kohli does not hit 100 runs, you keep this 20 rupees free for you. But in case if Virat Kohli hits more than 100 runs, for every 1 run he hits more than 100, I must pay you 1 rupee to you. Which means if he hits 150 runs, I have to pay you 50 rupees. If he hits 200 runs, I have to pay you 100 rupees. If he hits 300 runs, I have to pay you 200 rupees. And see here you are paying me only 20 rupees. That is called option premium. You are paying only 20 rupees. That's called option premium. If you lose, you are going to lose only that 20 rupees. If Virat Kohli is out before hitting 100 runs, that's it. You lose 20 rupees. The entire premium paid becomes 0. That money comes to me. But if he hits 200 runs, you are going to get 100 rupees. So that means your investment becomes 5 times. So your risk is limited, but your reward is unlimited. And the money that you are paying is called option premium. And we are deciding how many runs is going to hit, more than that. So we are talking about century, 100. So that 100 is called strike price. So 100 is the strike price. It is not necessary that the strike price should be 100 only. It can be 80, it can be 120, it can be anything. That's a mutual agreed numbers. You may do a betting. Virat Kohli will surely hit more than 80 runs, or Virat Kohli will hit definitely more than 120 runs, etc., etc. So now I told you what is option premium and I told you what is strike price. Now, what is a break even? Let us say you are paying me 20 rupees and saying that Virat Kohli will surely hit more than 100 runs. I always say sometimes for option buyer is something like operation success, passion dead. So you bet Virat Kohli will hit more than 100 runs. Let us say he hits 120 runs. So what you said, it has become true. You thought Virat Kohli will hit more than 100 and he has hit more than 100. He hit 120. But what will happen? Because Virat Kohli hit 120 runs, 20 runs more than 100, I will return you 20 rupees. But I will be returning the 20 rupees which I received from you. Whatever you received, it's for me. Then after that, more than 100 run, I return. So you pay 20 rupees, now you receive 20 rupees. That means you are not making any profit. So though you are betting that Virat Kohli will hit more than 100 runs, but you will actually start making profit only when he hits more than 120 runs. That is 100 is the strike price plus 20 is the premium paid. So strike price plus premium. And more than that, when he scores, then only you get the profit. So that is why here it's a break even. The break even is 120. Then there is something called expiry. So any contracts you are doing, there must be some expiry. So you cannot say, sir, Virat Kohli will hit more than 100. Then for the next 10, 20, 100 matches, he keeps on hitting. You cannot be counting. So the expiry date is either the end of this match or sometime even the match can be cancelled in between, right? So end of this match is the expiry, but which means you will get profit only if Virat Kohli hits more than 120 runs in this match itself. So there's a time frame. So that is called expiry. So in stock market in India, every month, last Thursday is the expiry day. Any options contract you are buying or selling, current month contracts expire on the last Thursday of the month. Then there is something called margin money. So what is that margin money? Now, look at the example of cricket. You pay 20 rupees by saying that Virat Kohli will surely hit more than 100. You lose, you are going to lose only 20 rupees, not more than that. But if you gain, you are going to gain 50 rupees, 100 rupees, 200 rupees, it can be anything. Suppose at the end of the match, Virat Kohli hits 200 runs and I'm supposed to return you 100 rupees. If I don't return that 100 rupees, if I run away, what are you going to do? So there is a risk. So that is why here any option buyer, he buys, the option seller has the obligation. Tomorrow, if there is a huge loss, he has to pay the loss. If the option seller does not pay, he run away. So that is why in between the exchange comes. Exchanges have a clearing corporations, subsidiaries. So they are responsible for the clearing and settlement. So exchanges will be collecting a huge margin money. Say in case of this example of Virat Kohli, you pay 20 rupees. Okay, there must be somebody in between you and me who is a center person, and he will take 20 rupees from you, he will pay to me. Then if I run away, if I have to pay 100, 200, then he will be taking some security deposit from me to meet your obligation. So that is called margin money. And in fact, recently SEBI has changed some rules in the margining system from people who are selling naked options, they are required to pay more margin, whereas the people who are hedging their positions, so they are required to pay very much less margin, and making hedging using options more effective, more interesting. Now, I'll give you another example. I'm not a great fan of cricket. So apart from cricket, I'll give you one example. Let us say your son is studying in a college, fresh from the college, and he come and propose you, he want to set up a restaurant. And he is asking 1 crore rupees to set up his restaurant. And you are worried because your son, he has got no experience in this business. Then you are coming and consulting me. Sir, my son is setting up a restaurant. He is asking for 1 crore capital. I'm worried whether his business will go well or not. Then I know about your son. I know his abilities. And also I know the restaurant business where he is proposing to set up a restaurant. I have a full confidence that your son will be running a successful restaurant. Then I'm coming and giving you one proposal. Okay, I'm giving you a deal. I will give you 10 lakh rupees free for you. I'm giving you 10 lakh rupees free for you. You go ahead and give them 1 crore rupees to your son to set up the restaurant. In case, if there is any problem, if he is not able to run the restaurant successfully, if he fails, you get to keep my 10 lakh rupees free for you. But remember, the loss in the restaurant business may be more than 10 lakh also. That I'm not sure. How much he will lose, that I do not know. But I'm giving you 10 lakh rupees free for you. In case if business loss is there, you get to keep this 10 lakh rupees. I'm giving you one more sweet deal. During the next 1 year, if he's losing the money in restaurant, you still keep my 10 lakh rupees. Even if you make profit, as long as is making profit from 0 rupees to 50 lakh rupees, still my 10 lakh you can keep. But why should I give so much money free for you? Then I put a condition. During the next 1 year, whatever profit your son is making, first 50 lakh of the profit you can keep. Beyond that, whatever the profit comes, you have to pass it on to me. Because I'm confident your son will be making 1 crore profit. So I give you 10 lakh rupees. If he makes 1 crore profit, first 50 lakhs you keep, then the remaining 50 lakhs you pass it on to me. So I give you 50 lakh. Now I give you, means like I give you only 10 lakhs. You are giving me 50 lakhs. So my investment is 5 times. So this is the option buying. And here I am an option buyer. You are an option seller. What is the strike price? Strike price is 1 crore 50 lakhs. That means your investment is 1 crore. If you talk only about the profit 50 lakh. 50 lakh is the strike price. Below 50 lakh, you get to keep. Beyond 50 lakh, whatever profit comes, you are passing on to me. What is my break even? My break even is 60 lakhs. Even if your son makes 60 lakh rupees profit, first 50 lakh you keep, the remaining 10 lakh you pass it on to me. That is what I paid to you. So I'm not making any profit. So I will get my profit only when your son makes more than 60 lakh rupees profit. So that 60 lakh is the break even for me. Right? So this is how the call options concept works. Now, let us talk about the differences between buyer and seller. As I explained in the two examples, setting up of a restaurant business and cricket match, you could understand buyer has limited risk. In the case of cricket match, you pay 20 rupees. If Virat Kohli does not hit century, you lose that 20 rupees. So 20 rupees is the maximum risk. So that's a limited. But what about my risk? My risk is unlimited. Who knows, Virat Kohli can hit even 500 runs. In that case, I take 20 rupees from you, I have to pay you 400 rupees to you, maybe 20 times. So option buyer has a limited risk, whereas the option seller has unlimited risk. Option buyer has unlimited reward. Say the same case. If Virat Kohli hits 500 runs, I have to pay you 400 rupees. You pay 20 rupees. Now you get 400 rupees. So your reward is so much. But whereas option seller reward is only limited. If Virat Kohli doesn't hit century, then I get to keep only your money, 20 rupees. That's my maximum profit. Buyer pays only the premium money. But whereas seller pay huge margin money to the exchanges. But when you read these first three statements, everything looks very favorable to option buyer. But the fourth one, which is very, very important, not many people know, sorry. The buyer probability of winning is very, very low. Whereas the seller probability of winning is very, very high. So this is a probability game. Now, so far we have discussed call options only. Now I explain put options. First, I'll give you the restaurant business example. Your son is asking you to pay 1 crore to set up a business, and you are not convinced about your son's ability or about the business, and you are coming and consulting me. Then I tell you, I'm giving you a good deal for you. You give money to your son, let him set up a restaurant, let him run. You pay me 5 lakh rupees. You pay me 5 lakh rupees. You should pay me free. In case if your son do business very well, make very good profit, be happy. But in case if he's losing the business, the first 10 lakh of the loss, you take it. First 10 lakh of the loss, you take it. Beyond 10 lakh, whatever is the loss happening, I will pay for you. So tomorrow, even if he has 50 lakh rupees loss, no need to worry. The first 10 lakh loss only you have to take. The remaining 40 lakh, I pay for you. And here, you are the your risk is limited to 10 lakh. You are trying to reduce the risk. So here you are the put option buyer. The 5 lakh rupees you are paying is the premium, put option premium. And you are a buyer of put option. Here the strike price is 10 lakh. Up to 10 lakh loss you have to take. Beyond 10 lakh loss, whatever happens, I'll give you. Right? So this is one way of doing the protection. Here, this insurance company also we do the same thing. You run a family, you have the risk. So you pay some insurance money. If nothing happens to you, you lose that money. But if something bad happens to you, the insurance company will pay you a large sum of money. So this is how the put option happens. As setting up a business also I explained. And call option, who are the buyers and who are the sellers? Theoretically I explained. Now I explain how they, in reality, hedging, how that happens. I'll give you one example. I was holding Reliance Industries shares. The market went to 1600. So I sold it. And after selling the share, I'm expecting the price to come down and I want to buy at the lower price. So with that expectation, I sold the shares. But what is the guarantee that the price will come down? It may not come down. It may shoot up. If it shoots up, I'll be in trouble. So what I do, I buy a call option by paying a small premium. So if the price comes down, I'm happy. Whatever shares I sold, I buy back. If the price is going higher, my call option will give me the profit. So this is how people buy the call option. Who are the people selling the call option? Let us say I have a State Bank of India shares with me. I bought the shares at 180 rupees and have the shares. So what I do, I sell 200 call option. So if the price goes above 200, I'm very happy because my underlying shares has increased the price. If the price is not going up, okay, anyway, State Bank of India shares I bought for long-term investment, so that call option profit is mine. So with this angle, people who sell call options, with this angle, people who buy the call option. So buyer of a call option, that means is very bullish. Seller of call option means is bearish. What about the put option? Who are the people buying and selling the shares? Put option. Put option buyer, he gets a profit when the price goes down. Okay, let us say I'm holding Infosys shares with me. And today some very important decision is going to be made. So because of that, the price may crash. Our price can go up also. It's called binary event. Price can go up also, can come down also. So let us say America is giving a very big contract to one Indian IT company, but they have not decided. They may give it to Infosys or they may give it to TCS. If Infosys gets the contract, price will shoot up 10%. If TCS gets the contract, Infosys share will crash by 10%. I'm holding the shares, but I don't want to sell it. But I'm also worried the price may go down. What I will do, I can go and pay a small money and buy a put option. So that if tomorrow market crashes, my put option will save me. Whatever loss happening in the underlying, put option will give the profit. If the price goes up, I'm very happy I'm holding the shares and small premium I paid for the option becomes zero. Then who are the sellers? Let us say Bajaj Finance share is trading around 2,500 and I want to buy the share. But I'm not comfortable in buying the share at 2,500. If it comes to 2,000, I'm ready to buy. But what is the guarantee the price will come to 2,000? There's no guarantee. So what I do, I go and sell 2,000 put option. So if the price comes down, let us say it comes to 1,900, then I have to pay 100 rupees to the buyer. But I don't mind because I get opportunity to buy the share at 2,000. So I'm not comfortable in buying any share at this particular level. But if I'm comfortable buying at much lower price, I can go and sell a put option there. If the price comes down, I'm happy. I can take delivery of the shares. So this kind of people sell the put option. So here I've given 4 examples. Who buy the call, who sell the call, who buy the put, who sell the put. I'm talking only about the people who are hedging and other things. I'm not talking about the speculators. So generally, a buyer of a put option means is a bearish person, and seller of a put option means is a bullish buyer. So I'm just giving you two strategies. One strategy is covered call. If you think that State Bank of India is a very good share and you are buying it, you are holding it in your demat account, then you can sell a call option at a higher price, so that if the price doesn't go beyond that strike price, you get some money. So I always tell my friends, some of my friends, they have the shares in the demat account, they never sell call option. But when I have the shares, I do sell a call option. I tell them, no, you have invested your money in a land, piece of land. Piece of land you invest, you only get the capital appreciation. You don't get the rental. I invested in an apartment. I get rental income also plus capital appreciation also. So capital appreciation is the capital appreciation of the share price. I get the rental income, which is a call option price. Of course, there are some risks. You rent an apartment. If the guy who rented your apartment, he break the window, he break the door, and he doesn't pay you, you may get into trouble sometime. The same way here in call option also, we may get into some trouble. Holding the share, selling a call option is called covered call. Second strategy is cash secured put. So this is what I told you just now in case of Bajaj Finance. You want to buy a share, but you are not comfortable at buying a share. At a lower strike price, you sell a put option. If the price comes below that, you can buy. If the price doesn't come below that, you get to keep the option premium of the put option. So either way you win. Price goes down also you win. Price goes up also you win. Hedging, there are some advantages and disadvantages. Let us say you buy a State Bank of India share at 180. You sell 200 call option. If the price goes beyond 200, there will be some losses in the call option. And of course, people who have got very good experience and they use a various combinations of option strategies, and they know how to mitigate this risk also. But that is beyond the scope of our webinar. And generally, so there are some advantages and some disadvantages. So if the price doesn't go above 200, so the call option is yours, right? Okay. So far what I explained is only about cash secured put, covered call. No, they're all talking about the hedging only. But there are people who just do trading using the options. And I always tell them, you see, Life Insurance Corporation of India, so they are selling insurance products to everyone. That is their business. But at the same time, they also carry a risk, and they go and insure themselves with the reinsurance company. So the same way, people, option selling is considered as a very good business, but due to the recent changes in the SEBI margin system, it is always good to do buying also. So they use various things like short strangle, short straddle, ratio spread, butterfly, put calendar, call calendar. There are so many strategies are there in options. Okay. So buying of options can be used for speculative purposes, and selling of options can be a good business. And here I'm giving you the contact details. So if you have any feedback or any questions regarding this webinar, you may mail to Sundar bscwebinar@gmail.com, and my YouTube is youtube.com/prsundar64, Twitter thing. So anything you want to communicate with me, we have given all the communication channels. My website is www.prsundar.com. I hope now you have more options in your life, and thank you for watching the webinar. Thank you.
Thank you, Sundar sir. Thanks for a great enlightenment with the traders, clients, investors, and all. As expected, you deliver the best, sir. Probably this is much lower to your level, not coming down and explaining ABC to the investors, traders, arbitrages, and physical market participants. Thanks a lot, sir. To the participants, I have a good news to say now. We also have our Sensex 50 features, options are available. And once you all learn basic things, and then please look into Sensex 50 feature and options also. And there are now cross margin availability also there. When Star said covered call, all those kinds of strategies, when you try to use different strategies, there are recently SEBI has permitted cross margins benefits, so that it will be useful for you to have a great learning. So to conclude this, thanks to Sri Samir sir, who had been present here to inaugurate the session, and thanks to Sundar sir for such a great exploratory, colorful learning evening. Everyone thoroughly would have learned it. It is like a school where you learn everything. They would have thoroughly learned about the basics of options. Thanks, Sundar sir. And I request all of the participants to watch the gold mini options on goods in BSC platform. Keep watching the Sensex 50 futures and options, and keep learning about options by doing trading or hedging or arbitraging with this. Thank you all the market participants, the physical participants, the hedgers, the arbitrators, the investors, the traders, for your learning here, spending time with us. And thanks to my Chief Business Officer, Sri Samir Patil sir, and Sri P.R. Sundar sir, and finally thanks to the Elan markets. So such a wonderful job they have done, to connect all these guys, all you guys here, and we had a wonderful learning session. Thank you all, including the Elan markets. Thanks a lot.